All right, so we are live, just making sure all systems are go, and we'll be diving in momentarily. All right, let's see. All right, so we are live. All right, so we are just making sure all systems are go. Okay, so we are good to go here. All right, so what's up, tax smart investors? Welcome to the weekly Facebook Live, where I'll be going live every Wednesday at 1 p.m. Eastern to break down tax strategies and tips for real estate investors. Today, I'm going to be going through the real estate professional status, also known as REPS, versus the short-term rental loophole. What's the difference and which one is right for you? So if you're interested in learning more about that, do stay tuned because I'll be diving into that in just a few minutes. If you're watching this right now on Facebook, do me a favor, go ahead and give this live stream a like and drop a comment because it does help the algorithm get this out to more people within the group and help them become tax smart. Also, if you are watching on YouTube, go ahead and hit that like button as well. And if you are on YouTube, I'd also encourage you to join our Facebook community if you have not already. You can do that by going to www.facebook.com/group/tax-smart-investors or simply searching Tax Smart Investors on Facebook to join the community where there's a ton of active conversations taking place about the short-term rental loophole, reps, and pretty much everything in between. So for all my Tax Smart insiders tuning in, we just recently released the Tax Smart Insiders Point System, which allows members to unlock premium courses and boot camps, which were previously only available for purchase or special offer as part of your membership. So the Tax Strategy Foundation course, the Real Estate Professional Tax course, as well as the QBO Bootcamp that's coming up, as well as other courses that we have in the pipeline. You will be able to unlock those by being a Tax Smart Insider. So I highly encourage you to check that out. If you're not already familiar with the Insiders Group, it's our private community where you can get access to our team of real estate tax experts, as well as exclusive content and resources designed to help you reduce taxes and gain clarity on your tax situation at a fraction of the cost of one-on-one tax planning. Again, today we're going to be going through the real estate professional status and short-term rental loophole, which is the right fit for you. But if you're part of this Tax Smart Insiders Facebook live stream today, I'm ready to give you the short-term rental tax course that's already helped over 600 investors understand and take advantage of the short-term rental loophole for free when you sign up for a 30-day free trial of our Insiders community. If you want that link, drop STR in the comments, and I'll drop you the link after the show. Again, just drop STR in the comments, and I'll shoot you over the link after the show, and you can get the STR task course for free with a 30-day free trial of the Tax Smart Insiders community. That being said, we're going to go ahead and dive right into the presentation. All right, just making sure all systems are still go here, and they are. Okay, so the real estate professional status versus the short-term rental loophole. What is the difference and when you should use each of these strategies? All right, so what we'll be covering is a brief view of the passive activity rules. So why do we even need to use the real estate professional status or short-term rental loophole in the first place? Then we'll be going through the real estate professional status, the short-term rental loophole, a summary of each and which you should use and when, and then next steps from there. All right, so why should you even care about the passive activity rules in the first place? Well, let's just think about it like this, right? All income producing activities, whether it's a business, a job, real estate, or stocks, bonds, things of that nature, are either passive or non-passive under the tax code. And passive activities come with certain rules that limit your ability to deduct your losses against non-passive income. And real estate falls smack dab in the middle of this passive bucket. And the strategies we're going to be talking about today allow you to bypass the passive status, allowing you to take the losses from your rentals against your active income, such as income from a W-2 job or an active trader business, and take those tax savings and reinvest it to grow your portfolio. So we don't want our losses to be limited. We want to be able to take those losses today, again, for those reasons. Now, why are the past activity rules and how do they come into to existence in the first place? Well, way back in the 80s, the Tax Reform Act of 1986 added Section 469 to the tax code, and it made all losses in excess of income from passive activities disallowed from being deducted against your non-passive income, again, like W-2 income or income from an active trader business. Instead, those losses are suspended and carried forward, and they can be used in future years. Now, the reason why these rules were put into place is because back in the day, a lot of high income earners would buy rental properties and other tax shelters and use the losses typically generated by depreciation, which is a non-cash expense, to significantly reduce the income on their W-2 job or their active trader business. And people just did not like it. There's a lot of controversy around it. So Section 469 was added to make certain activities passive. So that's kind of where we get into. So what are passive activities? All rental activities are passive by default, regardless of how much you participate, unless you qualify for an exception, primarily the real estate professional status. Then all trades or businesses in which you do not materially participate are also passive, right? So if you have an active trader business, like you're a consultant, real estate agent, broker, whatever the case may be, chances are that's an active trader business for you and you're all good. That's going to be in the non-passive bucket. But if you do not materially participate, like it's a passive activity, typically like limited partnership interests in businesses are typically fall in that bucket, then it's going to be in the passive bucket, right? And again, all income is either passive or non-passive. So if you want to check that out for yourself, I have the link noted here in this presentation, or you can simply Google Section 469. You can find out the full rules for yourself. Now, all rent, again, I kind of already covered this. All rentals are passive by default because a lot of people were abusing it. But then what ended up happening was Section 469, again, made it all rentals passive by default. But then they later added in the 90s the real estate professional status, which allowed you to use losses from your long-term rentals against your non-passive income if you met certain requirements, which we'll get into in just a second. So that's the first one, right? The real estate professional status allows owners of typically long-term rental properties, and in many cases, midterm rentals will also fall into this bucket, to deduct rental losses from their long-term rentals against their non-passive income to significantly reduce their tax bills. All right. Now, to qualify for the real estate professional status, you must spend more, you or your spouse must spend more than 750 hours in a real property trader business and more than half your total working time in that real property trader business in order to qualify. This effectively means that you need to work full-time in real estate in order to take advantage of the real estate professional status. All right. And the crux of that is the more than half your total working time in a real property trader business. So if you have a full-time W-2 job, it's virtually impossible to prove that you worked more than half your total working time in a real property trader business and qualify for the real estate professional status, as evidenced by over 500 tax court cases of people trying and continually failing to do so. So one quick thing I want to say here on the real estate professional status is that in order to qualify, either you or your spouse, and I know I mentioned this before, but it's super important, need to independently spend more than 750 hours. So you cannot combine your hours for the purpose of this test. You each must one of you must independently meet that 750 hours and work more than half your total working time. So we often see a spouse who's a high income earner. Maybe they own a business or run a business, or maybe they have a high income W-2 job. And then the other spouse may be able to qualify as a real estate professional. And in that case, you both benefit. But again, if you have a full-time job or you're running a business full-time, then it's unlikely you're going to be able to meet this, and you'd have to have a spouse meet the requirement for you in order to make this work. So who should use the real estate professional status? Business owners who work full-time in a real property trader business or have a spouse that is able to. Okay, so if you meet that requirement, you should be looking at using the status. And you own long-term rental properties, because again, as we'll be seeing in a second, does not work on short-term rentals. And you also have to manage your own long-term rentals, right? I'm going to break this down a little bit more detail here for everybody. All right. If you work full-time in a real property trader business, let's say you're a real estate agent or a broker, or maybe you own a property management firm, or perhaps you're a developer or fix and flipper, or maybe you're in construction, right? Say you might very well meet the requirements, 750 hours and more than half your total working time in a real property trader business, but that doesn't do anything for you, right? That just allows you to qualify as a real estate professional. Once you qualify as a real estate professional, to really make it useful to you, you need to own long-term rental properties. And again, midterm rentals typically fall in this bucket as well. And you also need to self-manage your properties, because if you delegate the management to a property manager, sure, you might be a real estate professional, but you also must prove that you materially participated in your rental activities. And that's typically done by self-managing your own rental. So again, to kind of sum it up, who should use a real estate professional? Either you or your spouse are able to work full-time, respectively, in a real property trader business. You own long-term rental properties, and you're open to self-managing those long-term rentals. All right. Now, real estate professionals will generally not help you if you own short-term rentals, because, as we'll learn in a second, short-term rentals often are not considered rental activities. Okay. Next, we have the short-term rental loophole, right? So if you own short-term rentals, this is a way around the passive by default treatment, because if in many cases, when you own those short-term rentals, you do not need to qualify as a real estate professional. Now, you do not need to qualify as a real estate professional because short-term rentals that meet certain requirements we'll go through in just a second are not considered quote-unquote rental activities under Section 469. So if you remember what we talked about at the beginning of this presentation, there are two types of activities, right? There are non-passive activities and there are passive activities. All rental activities are passive by default unless you qualify as a real estate professional, but business activities are only passive if you do not materially participate. If you materially participate in the business, then they're non-passive. So short-term rentals that meet certain requirements do not go in that rental bucket, right? They're not considered rental activities. Instead, they're considered businesses, which are not passive by default. Okay. And as long as you materially participate in the business, in this case, the short-term rental, then it'll be non-passive, and the losses have the ability to offset your W-2 or other income. So how do you qualify for the short-term rental loophole? Well, first, you must maintain an average period of customer use of 7 days or less, or 30 days or less if you provide substantial services, which are also known as hotel-like services, and those include things like daily cleaning, daily meals, things of that nature. All right, services you typically find in a hotel. And you must prove that you materially participate in your short-term rentals by meeting one of 7 material participation tests, with the 3 that we're going to talk about right here being the most relevant for most short-term rental owners. So that's your participation constitutes substantially all of the participation. Your participation is more than 100 hours during the year, and no one other individual spends more time than you. That's probably the most popular test because you spend more than 100 hours. And you could still have some people work for you as long as they do not spend, such as cleaners or handymen, as long as they do not, or in some cases, VAs, virtual assistants, and because they do not work more hours than you. And you participate in the activity for more than 500 hours for the year. Okay. Those are the 3 tests, the most common being the middle one. The reason, again, for that is for the reasons I mentioned, but the reason why the first test constitutes substantially all the activity is rarely ever used is because you'd have to be a one-person show. And if you start having cleaners clean the property regularly, or you're using handymen or virtual assistants to help you, then you're not going to be able to meet that test. Okay. You have to effectively do almost everything yourself, right? The 100-hour test helped. And then the 500-hour test, what we found, at least in our experience, it's very challenging for short-term rental owners to spend 500 hours, especially when you only have one short-term rental. All right. So who should use the short-term rental loophole? Well, owners of short-term rentals, okay, who can maintain an average period of customer use of 7 days or less, or 30 days or less if you provide substantial services. If you can buy a rental property that is profitable or makes the revenue you need to generate, or whatever the case is to make that business, that investment make sense for you, then you should consider using it. And you also need to basically self-manage the property and meet one of the material participation tests. If you can do that, then you're going to be able to meet the requirements. Now, this is great for people who own a short-term rental but can't work full-time in real estate, right? So if you own long-term rentals, again, the way to make those losses non-passive, you generally have to qualify as a real estate professional. All right. And that requires you typically to work full-time in a real property trader business. If you or your spouse cannot do that, then your next best option to be able to reduce taxes on your non-passive income will be the short-term rental loophole. All right. Because you do not have to work full-time. You simply have to materially participate and have your property maintain an average period of customer use of 7 days or less, or 30 days or less if you provide substantial services. but 7 days or less is the most common one of those exceptions to meet. All right. So quick summary here. And actually, it looks like we're going to have some extra time here. So if you do have questions on reps or the short-term rental loophole, go ahead and drop them in the comment. I see one person, Eric, has dropped a comment already, but we're going to be taking some questions. Okay. So go ahead and drop those in the comments if you do have questions. All right. So quick summary. All rental activities are passive by default. This limits your ability to use the losses from rental real estate to offset your non-passive income unless you meet an exception. One of those exceptions is the real estate professional status, and this allows owners of long-term rentals, and in many cases, midterm rentals as well, use those losses to offset the non-passive income generated from a W-2 job or an active trader business, as long as you are able, again, or you or your spouse are able to work full-time in real estate and self-manage your properties. The short-term rental loophole allows owners of short-term rentals that typically have an average stay of 7 days or less use the losses against their non-passive income when their property maintains an average stay of 7 days or less and they materially participate in the rental, right? So again, for the most part, if you work full-time in real estate, if you do not work full-time in real estate, which is the case for many owners out there, many real estate investors, they have a full-time job or business they're running, they invest in real estate on the side, then the short-term rental loophole will be the best strategy for you to be able to use the losses from rental properties against your W-2 or non-passive income and substantially reduce your tax bills. All right, before I open it up for questions, I just do want to say, I have one more slide after this, but I just do want to say that short-term rental hours typically do not qualify as real estate professional hours because there's been several tax court cases, including Bailey versus Commissioner and Todd and Pamela Bailey versus Commissioners, two unrelated taxpayers, just happen to have the last name, both confirmed that if the average period of customer use was 7 days or less, it was not a rental activity, and therefore the tax court viewed it not being a real property trader business, and thus the hours do not qualify for reps. So if you have short-term rentals, you cannot count the hours towards reps. You have to meet this. You have to basically use the short-term rental loophole in that case. So just something to keep in mind. We don't particularly agree with this, and there's reasons that I'm sure we'll share at a future juncture why that is. However, that is just the way the cookie crumbled. So if you're watching this presentation right now, you can get the short-term rental tax course for free when you start a 30-day free trial to the TaxSmart Insiders community. You can visit www.taxsmartinvestors.com/free STR course to get that today. I honestly don't know how much longer we're going to be offering this for. So if you want that, make sure you go ahead and grab that sooner rather than later. Now, if you are looking for a new CPA, I know there's a lot of people here in the community who join and are looking for a new CPA. I encourage you to check us out. We do work with real estate investors across the United States and pretty much all 50 states at this point on tax strategy and planning, which is how to reduce your taxes, tax preparation, as well as outsourced accounting services. And we do specialize in real estate, so we've seen just about everything at this point or have the resources to be able to figure it out relatively quickly compared to a lot of generalist CPAs out there who just do not understand this section. So if you're interested in scheduling a consultation to find out if working with us is the right fit for you and how we can help you, go head on over to www.therealestatecpa.com/Facebook, where you can request an initial consultation and we'll be able to help you. Okay. Having said that, I'm going to take some questions from the community that are coming in, and we'll keep going for the next 12 minutes or so. But again, if you do have questions after this, do feel free to join the TaxSmart Insiders community. Again, you can get that short-term rental tax course for free. It's right here up on the screen. I'm going to leave that there. All right. So we're going to go ahead and take this question. For short-term rentals, is there still a reason to do a cost seg if I can't meet the material participation requirement? For example, to offset some STR income? Yeah, so I'm going to break this down for everybody. I know we get this type of question a lot. So if you can't meet the material participation requirement, right, your short-term rental losses will be passive, okay? And what that means is that they can only offset other passive income. So if you were to do a cost segregation study, that could help boost your depreciation expense and help you offset your short-term rental income. So without knowing how large your short-term rental revenue will be and what your other expenses will be, it's hard to give you a definitive answer, but doing that cost segregation study can help you reduce taxes on that short-term rental income. All right. What I will say though, there is a downside. If you are able to materially participate, say next year, right? Maybe you can't do it this year. Then perhaps it would be better to wait to doing the cost segregation study next year in 2024, for example. The reason for that is that if you do a cost segregation study now, again, those losses will be passive. They'll offset your STR income, but the remaining amount will be suspended and carried forward to future years as passive losses. Again, next year, if assuming you have rental income from passive activities, it'll help you offset that income. It'll also help you offset the gain when you sell the property. But if you can materially participate next year, then perhaps it's better waiting, because then next year you can take those losses if you do the cost segregation study next year, right? Because if you do it this year, they're suspended, carried forward, and next year when you do materially participate, they're not unlocked. They're not going to be unlocked, okay? That's the issue. They're not going to become unlocked, and then in that case, you're not going to be able to use them. So to answer your question succinctly here, so we get some more, yes, it can make sense. Just understand that if you do plan to materially participate in a future year, it might make sense to hold off on that study. Okay. Next question. Can you explain how cost seg can reduce your taxable income? So the way cost segregation studies work, so say you have a rental property, right? When you buy that rental property, you're going to have income, you're going to have expenses. Now, one of those expenses is going to be a non-cash expense called depreciation. Now, typically when you buy a short-term rental property, for example, it's depreciated over 39 years. Now, what the cost segregation study does is breaks down the components of that property, because when you buy the property, you just don't have the building, right? You also have other things within the building, such as appliances, cabinetry, carpets, things of that nature. You also might have land improvements like sheds, pools, decks, things like that. What the cost segregation study does is it breaks down those components, assigns class lives to them. 5 years for things like the appliances, 15 years for land improvements like the sheds, the decks, things like of that nature. What the cost seg does, and what that allows you to do, is allows you to bonus depreciate the property with a class life of less than 20 years. And typically anywhere between 20 and 30% of the property's value can be reallocated, depending on the property's location, things of that nature. So basically what it does, again, it boosts, long story short, it boosts your non-cash depreciation expense significantly, creating losses that are non-cash that can offset your W-2 income if you qualify as a real estate professional and it's a long-term rental, or you can use the short-term rental loophole and the property in question is a short-term rental. So hopefully that answers your question. It just basically, long story short, boosts your depreciation expense significantly in many cases, allowing you to significantly offset your income. All right. I'm going to go for this one right here. There's a few others, but we're going to go for this one. What is a cost seg? Okay, so I kind of just explained that. I'm going to just give another quick breakdown on it for the sake of clarity. All right, again, so you buy a property, it's going to have a useful life of either 27 and a half years in the case of residential long-term rentals, or 39 years in the case of commercial property, which many short-term rentals fall into. So that means every year you're going to get a very small depreciation expense. What a cost seg does is it breaks down those components of the building into shorter class lives, allowing you to accelerate the depreciation. Now, the property with a class life of less than 20 years, such as tangible personal property, which is a class life of 5 years, or land improvements that have a class life of 15 years, those could be depreciated over 5 or 15 years. And because they have a class life of less than 20 years or less, you can use bonus depreciation to substantially increase your taxable income. So I hope that kind of explains it. I know we broke this down in other posts and other presentations, but in a nutshell, cost segregation studies allow you to boost your depreciation expense. Okay, looks like that's answered. I heard bonus depreciation goes away after this year. Is that correct? Okay, so bonus depreciation is not going away this year. Bonus depreciation was put into play. Well, there's been forms of bonus depreciation before 2017, but the Tax Cuts and Jobs Act made bonus depreciation 100%. So you were able to completely depreciate property with a class life of 20 years, all in less than 20 years, all in 1 year, from basically September 27th, 2017, very specific weird date, but that was the date, through December 31st, 2022. So for example, We're getting a lot of this question here, so I'm just going to give you a quick example of how this would work while we're here on this presentation today. I'm just pulling up my calculator so I could just run through the math for everybody. Here's the example, right? Let's say you buy and this ties into cost segregation. All right. Let's say you buy a $500,000 property. Land is never depreciated. So let's just, for the sake of this example, we're going to assume that 20% is allocated to land. That's $100,000. So now you have a building value, or the house, the home, the condo, whatever the case is, right, is going to be $400K. All right. Now that $400K would typically be depreciated over, in the case of a short-term rental, let's assume it's a short-term rental, over 39 years. So every year you're going to get a $10,256 depreciation expense, roughly. All right. But if you use a cost segregation study, you can typically depreciate anywhere between 20 to 30% of that building value. Let's just be conservative. We're going to take 20%. So that's $80,000, right? Now, if you were to buy that property and place in the service anywhere between September 27th, 2017 to December 31st, 2022, you would have been able to fully deduct this $80,000 using 100% bonus depreciation. So that means you would have an $80,000 deduction from a non-cash expense. So depreciation, with the expense we're talking about here, does not necessarily take money out of your pocket. It's non-cash. It's a phantom expense. It only exists on paper. So you would have been able to take that full $80,000 expense, and usually it's going to generate a sizable loss. This loss would help you offset your W-2 or non-passive income, okay? Now, having said that, 100% bonus depreciation is no longer available. Starting in 2023, bonus depreciation phases out 20% per year until 2027, and when it's no longer going to be there, at least under current law. So again, 2023, it drops down to 80%. So what does that mean? It basically means that out of this $80,000 in this example, you would have only gotten a $64,000 deduction. Still pretty powerful, though. Still pretty powerful. Now, in 2024, it's going to drop down to 60%. So it's not going away. Not going away after this year. It's just dropping down to 60%. So if we take the same $80,000 example, we're looking at an expense of $48,000 in the first year in 2024. All right. Now it's going to drop down to 40% in 2025 and 20% in 2026. Excuse me. And then 2027, it's gone. So no, it's not going away. It's just dropping down another 20%. And what does that mean? That means that if you want to take the best advantage of the short-term rental loophole or the real estate professional status, the full advantage of it, or the maximum advantage that you can today, you want to buy a property, make sure it's placed in service this year. And if you're using short-term rentals, that it's rented out at least twice this year. But it's not going, again, long story short, not going away. All right. Now we have another question. Okay. New property owner closing in 45 days. The hours spent before closing and getting the property set up count as material participation, or only hours logged after the property goes into operation? So it's a great question. There's a little bit of a lack of clarity over to specifically how this works underneath the tax code. However, what I will say, though, is that we've been of the belief that once you put the property under contract and you're making serious moves towards closing it, that's when the hours start counting if you're going to be involved in the day-to-day management after closing. So the hours that would count is negotiating the contract, inspecting the property before rent, and handling the other tasks that are typically required to actually go through the acquisition process once it's under contract. Then once you actually acquire the property, the time you spent on repairs, maintenance, capital improvements, getting the property in rent-ready condition is typically also going to qualify, okay? So as material participation. So I hope that answers your question right there. Now, if you're going to hire a property manager, to be clear, on the flip side, you're typically not going to be considered to be involved in day-to-day management. And in that case, you might not be able to deduct these expenses. Just something to think about. All right. See, do we have any other questions? Okay. So going once, going twice. If you're watching this right now, there's still a few people hanging in there. If you do have any questions, drop them in, and then we'll see if we can get you an answer. All right, I'm just checking on the other screen, make sure there's nothing coming in. All right, so that's going to be it for today. Just want to let everybody know we are not going to be doing a Facebook Live next week. I'm going to be out of town traveling, so unfortunately, I'm not going to be able to tune in with everybody. But I want to thank everybody for attending this, catching this live. Again, if you are looking for a new CPA, Hall CPA, the firm that runs this group, we are taking on clients, okay, for the 2023 tax year. And you can learn more about that by going to www.therealestatecpa.com/Facebook. You'll be able to fill out a brief form, and our team will reach out with next steps about scheduling an initial consultation where we'll learn more about your situation and how we can help. Thank you, everybody, for the kind words. Thank you. Thank you. Thank you. And we have another one. Really appreciate it. Lets us know that we should continue doing these. Also, if you want to grab the short-term rental tax course, you can grab it for free by starting a 30-day free trial to the TaxSmart Insiders community. You could do that by going to www.taxsmartinvestors.com/free STR course, and you can get access to that course for free. Looking forward to seeing everybody on the inside. Again, thanks for tuning in, and we'll catch you not this week, but the following week.